Investing doesn't have to be complicated. Many investors seek straightforward ways to grow their wealth. Mutual funds and index funds present two such avenues. Both offer a simple approach to investing in a basket of stocks or bonds. This can help diversify your portfolio and potentially reduce risk. Mutual funds are professionally managed investment vehicles. They pool money from multiple investors. Fund managers use this capital to buy a diversified portfolio. The portfolio might contain stocks, bonds, or other assets. Index funds, on the other hand, are a specific type of mutual fund. What sets them apart? Index funds passively track a specific market index. The S&P 500 and the Dow Jones Industrial Average are examples of market indices. In essence, both mutual funds and index funds provide valuable tools for investors. They offer diversification and a simplified approach to navigating the complexities of the financial markets. Understanding their differences is key to making informed investment decisions. Mutual funds are like baskets of investments. They hold a collection of stocks, bonds, or other assets. These funds are managed by professionals known as portfolio managers. These managers actively buy and sell securities. Their goal? To outperform the market and generate returns for investors. Mutual funds offer several potential advantages. Diversification is a major plus. By investing in a variety of assets, mutual funds spread risk. This can be less risky than holding individual stocks. Professional management is another benefit. Fund managers leverage their expertise. They aim to make profitable investment decisions. However, mutual funds come with costs. Management fees and operating expenses can eat into returns. These fees compensate fund managers and cover administrative costs. The performance of actively managed funds can also vary. Not all fund managers consistently beat the market. Despite these factors, mutual funds remain a popular choice. They provide a relatively easy way to access a diversified portfolio. Investors delegate the investment decisions to professionals. This can be appealing for those without the time or expertise to manage their own investments. Index funds are a type of mutual fund. They passively track a specific market index. For example, an S&P 500 index fund replicates the S&P 500 index. Index funds aim to match the market, not beat it. They have lower fees due to less active management. Index funds are also more tax efficient. Historically, they often outperform actively managed funds. MAR fees. A key difference. When comparing mutual funds and index funds, consider the management expense ratio, or MER. The MR covers the costs of managing the fund. Mutual funds have higher MERs due to active management. Index funds have lower MERs due to passive management. The difference in MRs can impact your returns over time. Section 5. Tracking ease. Simplicity of index funds. Another key difference between mutual funds and index funds lies in their tracking ease. Index funds are inherently easier to track as they follow a predetermined index, making their performance more predictable. Investors can easily compare the performance of an index fund to its benchmark index, track the fund's holdings, and understand its investment strategy. This transparency provides investors with peace of mind, knowing exactly what they're investing in and how the fund is performing. Conversely, mutual funds, with their active management, can be more opaque. It's not always clear what securities the fund manager is buying or selling, and the fund's performance can be influenced by the manager's skill and judgment. This can make it harder for investors to track the fund's progress and understand its risk profile. The simplicity and transparency of index funds are particularly appealing to passive investors who believe in the power of long-term buy-and-hold investing. They prefer to track a broad market index rather than trying to beat it through active management. Section 6. Conclusion. Choosing the right fund for you. Both mutual funds and index funds offer valuable investment avenues. The best choice for you depends on your individual circumstances, risk tolerance, and investment goals. Mutual funds, with their active management, may appeal to investors seeking to outperform the market. However, they come with higher fees and greater complexity. Index funds, on the other hand, offer simplicity, low costs, and the potential for competitive returns over the long term. If you're new to investing or prefer a hands-off approach, index funds can be a great starting point. They provide broad market exposure, diversification, and a simple way to participate in the growth of the stock market. Ultimately, the key is to educate yourself about the differences between mutual funds and index funds. This will equip you to make informed investment decisions that align with your financial goals.